Welcome to Business with Louis, the show where we dive into the world of entrepreneurship and explore the concepts that can make or break a business. Today, we're talking about understanding market corrections versus crashes, a crucial topic for any investor or entrepreneur. To start, let's define what market corrections and crashes are. A market correction is a decline in the stock market of at least 10% but less than 20%. Typically occurring over a short period. On the other hand, a market crash is a more severe decline of 20% or more, often happening suddenly and unexpectedly. Understanding the difference between these two phenomena is vital because it can significantly impact your investment strategy. The concept of market corrections and crashes has been around for as long as the stock market itself. Historically, market corrections have occurred about once a year on average, while crashes are much rarer, happening only a few times a century. One notable example is the 2008 financial crisis, which was triggered by a housing bubble burst and led to a global recession. At the heart of understanding market corrections and crashes are core principles like sentiment analysis and economic indicators. Sentiment analysis involves gauging the overall attitude of investors towards the market, which can be bullish or bearish. Economic indicators such as GDP growth rate, inflation rate, and unemployment rate provide insights into the health of the economy and can predict potential market fluctuation. Let's look at some real-world examples to illustrate how understanding market corrections versus crashes plays out in practice. The 2020 COVID-19 pandemic led to a sharp decline in global markets, but swift actions by central banks and governments helped mitigate the damage, turning what could have been a crash into a correction. Companies like Zoom and Amazon saw significant growth during this period due to increased demand for their services, demonstrating how some businesses can thrive even in challenging market conditions. For practical applications, it's essential for entrepreneurs and investors to diversify their portfolios, spreading investments across different asset classes such as stocks, bonds, and commodities. This strategy can reduce risk by up to 30%, according to a study by Vanguard. Additionally, adopting a long-term perspective is crucial. Panic selling during market downturns can lead to significant losses, while staying invested can yield substantial returns over time. A study by Fidelity Investments found that investors who remained in the S&P 500 throughout the 2008 financial crisis and subsequent recovery would have seen returns of over 300% by the end of 2019. Another valuable strategy is dollar cost averaging, which involves investing a fixed amount of money at regular intervals, regardless of the market's performance. This approach can help reduce timing risks and avoid making emotional decisions based on short-term market movements. It's also important to stay informed but not let short-term volatility dictate investment decisions. Trusting one's own analysis and maintaining a disciplined approach is key to navigating market fluctuations successfully. In conclusion, understanding market corrections versus crashes is a critical concept for anyone looking to succeed in the business world. By recognizing the signs of a correction or crash, entrepreneurs and investors can adjust their strategies accordingly, minimizing risks and maximizing gains. Remember, every great business starts with action, but it's also about being informed and prepared. As my experience with market cycles has taught me, resilience and adaptability are just as important as prediction. To recap, the key takeaways from today's episode are: sentiment and economic indicators can provide valuable insights into market trends. Stay informed, but avoid making emotional decisions based on short-term market movements. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.